So what is the new landscape in regards to buy-to-let mortgages? Well, check this video out as I interviewed Sekipan from Natu Finance, where we discussed mortgages, limited company, section 24. Check it out. Hi everyone, my name is Simon Misiewicz, your Finance and Tax Director. I'm here solely to help you grow your wealth and reduce your tax liability. Today I have the pleasure of doing an interview of sorts with Sekipan, who is from Natu Finance, and he's going to be talking about buy-to-let mortgages, whether that's in your own personal name or in a limited company. So Sekipan, why don't you introduce yourselves to the viewers?
Thanks, Simon. Thanks for the introduction. Well, I'm Sekipan from Natu Finance. I've been a mortgage advisor for the last 14 years. Residential and buy-to-let is primarily what I focus on. A bit on commercial, but my focus tends to be on residential and buy-to-lets. Seen a lot of changes over the years, so I'll be happy to discuss how buy-to-let mortgages are currently and the complications that have come about recently.
Okay, thank you ever so much. And in this first section, I'm going to be asking Sekipan all about buy-to-let mortgages in 2020 and how they've changed for property investors and landlords alike. So, Sekipan, I've obviously seen a lot of news about there's a lot of people exiting the marketplace because of Section 24. Section 24 mortgage interest relief costs are not allowed in personal names anymore. How is that affecting buy-to-let mortgages in personal names? Is that coming more difficult or easier now?
In terms of the key change, because came about in 2017, I would say, from a mortgage perspective. I know you've touched upon Section 24 that has more of a tax impact, but the PRA, the regulatory authority, brought in changes in 2017, which meant they restricted the amount of mortgage borrowing that somebody can have at a given rental income. So prior to 2017, the lenders had their own affordability criteria. They had their own free arm on how much mortgage they could lend. Then it was simply a case of my property is worth 100,000, I'll have 75K. 75% was more or less the loan to value in most cases then. Then comes 2017, where the PRA says, ideally, a mortgage lender should stress test the rental income at 145% of 5.5. Now that's been prescribed to the lenders, so all lenders are ideally looking to adhere to that requirement. What that translates roughly in terms of my explanation to the clients is for £1,000 of rental income per month, the regulators ask the lenders to ensure they lend only £150,000 as a mortgage amount. So at that point, it's no more about loan to values. It's yes, you have a maximum, an ideal loan to value of 75% where you can't go anything more than 75% for competitive rates. But what does tend to happen is, although there's loan to value, which is a separate element, the rental income starts to really be restrictive. Now, over the last 2-3 years, lenders have come about with various ways in which they can circumvent that. But that one specific change, I think from my position as a mortgage advisor, that I think that's having a bigger impact than potentially Section 24. Yes, Section 24 has implications on the taxation, but in terms of clients being able to purchase the property, no longer can they just put in 25% deposit and move on. The maximum mortgage is what's really causing a concern. There are several ways in which we could overcome this 150K per £1,000 of rental income, but that's all client specific.
Yeah, okay. Case by case basis, I would have thought.
Case by case basis. Now that the rules have sunk in for some time, different lenders are coming down with different strategies on how they can help get to that extra bit. But going back to your question of what's the change, early days when these comes by, buy-to-let was definitely dipping, but now people are getting to have an understanding of how this works. They know what they can do to circumvent and try and get back to a higher mortgage. So I would think there was a sharp dip without a doubt in terms of buy-to-let mortgages. But now the more serious buyers, the more serious players who want to be into buy-to-lets are finding ways to come around it. and those accidental landlords, as they're often called, who do not intend to become a landlord, but they are there by means of circumstances, are looking to come away. So it is still interesting times. It's more challenging, but there are solutions to be made for each client's circumstances.
Yeah, it's an interesting phrase you use, because I think labeling of people is the norm. But there is the phraseology of the amateur landlord and the professional landlord, and it's interesting how even the lenders are categorizing people in such a way. I mean, in terms of accidental landlords, because of the PRA changes and potential tax changes, but combination of the two, are you seeing personally that there's less of the accidental landlords coming to you and more of the professional landlords, or are you not seeing that at all?
Definitely. I am thinking, I mean, where somebody was just thinking, okay, I've got a pot of cash, let me invest it into property, and not looking at that as a serious business, is definitely dropped. The more accidental landlords we see are the ones who've got a current residential, they don't want to sell that, they want to retain it and then buy another one. So a let to buy of their primary residence and then buying another property for buy to let is happening more. But the general shift is those who already understand the implications that have been brought about with the recent changes are still looking to purchase. More professional landlords is what we are seeing.
Okay. And talking about interest rates, because interest rates are really still very low, in my opinion.
Yeah.
Do you think it now is a good opportunity to go into fixed term, long-term mortgages to really cap that interest rate?
Very good question, because going back to the maximum loan size I was talking about, one of the ways in which a lot of the lenders have circumvented this PRA stipulation of, maximum of £150,000 loan for £1,000 rental income, they were able to do so with 5-year fixes. So what we've seen in the last 2-3 years is an increasing shift to a 5-year fixed mortgage. So where we had a lot of buy-to-let clients wanting to do a 2-year fixed and then review their circumstances in 2 years, and fingers crossed, raise more money to buy another property at the end of 2 years. We're seeing that going into 5 years because the stress test from lenders is more favorable when they're doing a 5-year fixed. And as a result, A, for the loan size, and B, for the competitive interest rates that are available in the market, I would probably say we are looking at about 80 to 90% of the clients going in for a 5-year fixed on a buy-to-let as opposed to a 2-year. There have been mentions about 10-year fixed, but to be honest, that's not very popular. There are some deals out there, but there's not a big uptake of such deals. So the industry trend is to consider a 5-year fixed and then try to see what best you can borrow on that.
I mean, I appreciate you can't give us a very specific, but if we look at the average rate of someone buying a £200,000 property, very good earnings, good in terms of interest cover, etc. What kind of interest rates based on that scenario could someone expect? And I appreciate we can't hang you to these numbers, but if you're comparing the interest-only interest rate versus a fixed rate interest percentage, what would we be looking at right now?
So, it's a pretty good question. I mean, you're looking at, in personal names, we're still holding it on to. In personal names, the interest rates are pretty good. We've not seen the 1 points for buy-to-lets in a long time, but then you're having deals that's up below 2% as well on personal names. And the 5 years tends to be about 30 to 50 basis points higher than a 2-year fixed. So you're still looking at sub 2 for buy-to-let rates, which is very competitive. And one different answer I want to give you on the back of your question, you said good incomes. Many a times, the mortgage amount that somebody can get when they are in very low incomes is higher because the lenders take into consideration that they're basic rate taxpayers. Lenders tend to like clients in terms of giving a higher loan amount if they tend to be on lower rates. There are some lenders who would like them to be on higher rates, but that's... So if there is somebody who's not a high wage earner, who's not on a higher tax rates, the chances are they can get a higher mortgage than those who are already higher rate taxpayers.
Okay. That's really good. So hopefully, guys, you've taken a lot out of what we've said today about where we are with buy-to-let mortgages in your own personal name. In the next section, we are going to cover off buy-to-let mortgages in a limited company. So make sure you do watch that video, and the link will be appearing below us in the comments box. See you in this video. Okay, so we can pause on that one.
Sure.
Did that go okay for you?
Yes, that did. Yes, I mean, I wasn't. I should look at what your thoughts were, but I was happy with that.
Yeah, I think it's a good overview. I think that's more than what we can expect for, so that's good. So this one is going to be purely focusing on mortgages in a limited company.
Okay.
So I will kick off with that, and then we'll go to that subject. There'll be a talk back about the previous session that we've done, so I'm going to edit the first bit and copy that over. And then what I'd like to talk about is death. Not a topical conversation, but you know, there's things like IHT. And before we, in fact, what I'm going to do is just pause that video. All right, in the last video, Sakiban and I talked about having a buy-to-let mortgage in your own name. So make sure that you go and watch that video. A link should be appearing just above my head right now. But in this session, we are going to be talking about buy-to-let mortgages inside of a limited company. And before we go into the Q&A session, one of the reasons why people are moving to a limited company is for tax reasons. We know that Section 24, mortgage interest relief cap, does have a negative effect on someone's financials. They use a limited company because the corporation tax rate from April 2020 is just 17%, which is phenomenal because it's even less than someone's basic rate tax band at 20%. And you can offset 100% of the mortgage interest cost against rental income. So really a good double whammy there. But we do need to understand mortgages and how it comes into a limited company in the process. So Sakiban, if you can give me from your perspective, how easy is it to get a mortgage inside of a limited company?
Yes, Simon, of course. In terms of getting the mortgage itself, it is not very difficult. As long as there's no more than 4 shareholders, which is what most lenders take into consideration, getting a mortgage on a limited company is not a problem. Very often I get asked as to how will they be able to get a mortgage on a company that's yet to be set up. So all of the decision is made on the individual applicants or the shareholders. So the credit score, the income, all of this is taken on a personal basis. And the lenders are able to issue the mortgage under a limited company that's just been set up for the purpose of the mortgage. One thing they would insist on is having a bank account in the name of the limited company at the time of the application. Apart from that, it is fairly easy to get a mortgage under a limited company, or rather it's not any more difficult to get a mortgage under a limited company than under personal names. So everything pretty much remains the same.
Okay, so I was quite surprised to hear you say it is just as easy to get a mortgage inside a limited company because so many of our clients are doing so. So that certainly surprised me. So from your perspective though, what's the mortgage interest rates? Because I'm always saying to clients, well, I think the process of using a company to get a mortgage is more difficult. Well, you've just clearly clarified that it's not. But what about mortgage interest? If someone can get a buy-to-let mortgage in their own name at 2.5%, let's say, what typical percentage rate are we looking at for a limited company?
Yeah, the interest rates for mortgages under a limited company is going to be higher. So the difference we are seeing is if you look at a typical 5-year fixed, which is what a lot of people are doing given the loan sizes, under personal company, I'm comparing the best of lenders in both scenarios. The best rates you can get in personal names is currently at about 2%, there or thereabouts in terms of 2%. But the same for limited companies is about 3.6%. So there's a vast difference in interest rates between personal names and limited company names. 2 other things to bear in mind apart from the interest rate itself is the arrangement fee with the limited companies tend to be a little bit higher than those of personal names. It could be sometimes percentages such as 1% of the loan amount, where the loan amount could be higher, then the arrangement fee tends to be higher with that. And so generally speaking, not just the interest rate, the arrangement fee also tends to be higher with limited companies. And as much as we said the process of getting a mortgage under limited companies is no more complex, the amount of work involved slightly increases because most lenders ask you for an independent legal advice for the directors who give the personal guarantee. So there tends to be one solicitor acting on the purchase and a different set of solicitors providing the directors independent legal advice. That increases the cost to an extent for another set of professionals and also increases the time span. So yes, it works well. Getting a mortgage under limited company is not very difficult, but the rates, the arrangement fee, and the cost of setting up could be slightly higher. And usually we will make this clear upfront so the client knows and makes an informed decision.
Okay. Now, one of the things that we have, and thanks for clarifying that as well, one of the things that our clients talk about is putting their children onto the shareholders. And I'm kind of reluctant to do so because I think if you're buying a property inside of a limited company, you can use share structures for shareholders as ABC shares, or called alphabet shares, if you will. And it helps from a tax planning angle. But once you put children onto a company, I rather suspect that banks are a little nervous of that kind of arrangement. Am I right in saying that?
Generally speaking, yes, most lenders would not come back, would not readily accept this. However, I've seen some lenders come back and talk to us as their unique selling proposition where the clients would like to add children back to them. With so much only that the lenders can do in terms of competing with each other on interest rates, we see a lot of them competing on criteria. So there are lenders really making a big noise about the fact that they can have children added into their mortgages. If that's the right thing for the clients to do from a tax angle and from their own independent personal circumstances, we can find lenders who would allow them to do that. And we can arrange that. And surprisingly, the rates are not going to be higher just because you want to add children. Some of the lenders who give the best rates are still happy for children to be added on within. Wow. And it's got to be children of the shareholders and nothing outside. So that's what they would look at.
Great. That's really good to hear, to be fair. That's really good. And just going back into the process and application, typically, how long does it take to get a mortgage in someone's personal name if it's relatively straightforward versus a limited company?
Okay, so the process of getting the mortgage is not becoming any more difficult or any more long. Our processes are pretty much the same. That you can't see a distinction between how long it takes for a mortgage under personal names versus a mortgage under limited company names. It's pretty much the same. Sometimes we can see a slight delay because the client's not set up the company or the company house is not updated the details. We're probably talking a couple of days here and there, but given that we've got all of it, the process is exactly the same. Perhaps upon completion, it can take an extra week or so because of the independent legal advice that exists within a limited company, but not within personal names.
Great. Okay. There you go, folks. So that is how you can get a mortgage inside of a limited company. Hopefully that's helped. And from someone who's investing inside of a limited company for tax purposes, you now know what to watch out for from a mortgage perspective as well. In next episode, we'll be talking about mortgages. And one of the phrases I like to use, or not so like, is the one certainty we all have: life, death, and taxes. And in the next episode, we'll be talking about death, taxes, and mortgages. So if you have got concerns over that subject, then make sure you go and watch that video too. See you again soon. Well, why not book a call with me, Simon Misiewicz, your Finance Tax Director, for at least an hour to understand how we can help you grow your business without paying the tax.